Now, President Joe Biden is seeking to inject confidence into the US banking system today after a dramatic weekend in the financial sector when the Silicon Valley Bank collapsed. In a speech before markets opened today, Biden said people and businesses who do have money deposited with the bank will be able to access all of their cash. It is, though, the largest failure of a US bank since the financial crisis of 2008. Well, joining me on the line now to discuss is Victoria Scholar. She's with the investment company Interactive Investor based in London. Good afternoon to you, and thanks very much for joining us.
Thanks so much for having me.
How serious a moment do you think this is for the banking sector?
Well, it's interesting because there were a whole range of measures carried out over the weekend in terms of supporting the banking sector in the United States. And markets were poised to open higher before the US Open. We're just opening now, and it looks as though markets are lower. We saw markets struggling in Europe this morning, with the banking sector leading the declines. So although this might not be as serious as the 2008 financial crisis in any way, there are some parallels. It's the biggest banking collapse since then, like you say, in 15 years. And it feels as though there is still a crisis of confidence for investors, which is why some of the banking stocks are down 5%. Credit Suisse, for example, is down even more than that. So there's still quite a long way to go in terms of shoring up confidence within the sector.
Well, speaking of trying to restore confidence, the President spoke within the last hour, just before markets open in the United States. They've only been open for a few minutes now over there. Do you think, based on what the President said, that he will have succeeded in calming some of those concerns by investors?
Well, he did say that he's going to do whatever is needed. He spoke about the previous administration under Trump and talked about the wind back of regulation that was brought into place around the time of the banking collapse in 2008. He said he wants to go and speak to Congress and regulators to try and strengthen those banking rules. But interestingly, he talked about investors and said that they're actually not going to be protected. They're not above the law, and they should understand the risks that they take when they invest in a bank. Markets, as we know, go up and down, and sometimes businesses can fail, and that's part and parcel of investing. So I think his message was firm but fair. So far, I don't think it's done enough to alleviate the market unease, but certainly it is a step in the right direction to try to stem a much broader crisis within the whole financial sector.
And I also noted that line that you just quoted there from Joe Biden saying nobody is above the law. I mean, what did you make of that? Is there an implication there from Biden that there are some people in this sector who've acted recklessly this time, not perhaps dissimilar to the start of the financial crisis in 2008?
Well, I think Silicon Valley Bank got caught off guard with the declines last year in the bond market. It had a $1.8 billion loss on its $21 billion bond portfolio, essentially because it didn't think that interest rates would rise in the United States as quickly as they did. It wasn't that Silicon Valley Bank was taking excessive risks. It was investing in very vanilla assets like US Treasuries, government bonds, and other similar products. These weren't kind of Wild West financial products at all. It's just that it was caught offside. So I think that this is more an issue around risk management rather than the style of investing itself. And there are a lot of investors who got caught offside with this. We were awash with cheap money since 2008 that's spurred gains in the tech sector, predicated on cheap money and high levels of borrowing, that's seen asset prices and equity markets stage very strong gains over recent years. And a lot of those gains, particularly in the tech sector, were accelerated during the pandemic when all of us were glued to our smartphones and Zoom and Netflix and all these other tech products that we were highly dependent on. But once inflation came back and those rock bottom interest rates were removed, the punch bowl of cheap money was taken away. That has had huge implications. We saw a big re-rating in the tech sector to the downside last year. We've seen a major repricing in the bond market. And unsurprisingly, some people have been caught off guard.
Can we talk briefly about potential banking contagion, though? You're in London, of course, and there have been steps over the weekend in the UK to protect the UK arm of the bank that's now collapsed. Is that enough, though, to prevent this spreading across the pond and a deeper contagion, perhaps even across the world?
Well, I think that there are serious implications for other stocks within the banking sector. We've seen First Republic Bank, for example, its stock has plunged by about 65% pre-market, and this is amid concerns that customers could suffer, could pull out their money, and the bank could suffer drops in deposits, and in turn that could affect its profitability. Charles Schwab is another broker, which is down quite significantly. Again, there are concerns about what it could mean in terms of deposits, but some are saying that actually this could play into the hands of some of the larger lenders that people feel are more kind of have more confidence and are bigger and more difficult to fail. And so if we do see more banks collapse, which hopefully won't be the case, but at least in terms of Silicon Valley banks collapse, there is some market share to be swept up. So perhaps that could go into the hands of some of the more established lenders, say like JP Morgan or Morgan Stanley and the other major Wall Street players.
Victoria Scala from Interactive Investor live in London. Thanks very much indeed for your time and for your analysis today.